Global equities are at new all-time highs as of yesterday, and it's all a constructive story. Global growth continues to surprise, and we're seeing broadening effects. That is, the US is no longer in charge, it's now a European story. We're going to dive into that story for you today and cover what is driving global equity markets. Welcome back. It's Thursday the 16th of May. Today we're going to provide more colour on why we're seeing new all-time highs in global equities, driven by highs in the US, Europe and the UK. Very much a broadening global growth story, driven by real GDP expanding, particularly in Europe. And just as importantly, we're seeing the cooling effects in the US, such that markets are no longer worried about interest rate rises. And in fact, maybe as early as next month, we might see some cuts begin, particularly in Europe, feeding into the UK. And there may be enough of a disinflation impulse in the US for there to be one interest rate cut sometime in the autumn. And this rebalance between growth and inflation is important because markets can now focus in on aggregate demand because the starting point for economies is so strong. We're at full employment and many of the headwinds for inflation are beginning to fade. Where the UK lagged in the economic cycle with a slower rebound in growth post-COVID and a much higher inflation headwind, those effects are now turning into tailwinds. With high employment here, it's hopeful that growth could land somewhere between 1% to 2% this year, very much reflecting the same story in Europe, which is that both economies were near recession at the end of the year, but are now growing sufficiently such that there should be further upside surprises in growth expectations. And if we bring this into a narrower focus, yesterday's inflation data in the US was encouraging. Core inflation fell further, and there's now clear signs that US inflation is sticky in a range of around 3 to 3.5%, and that may just be enough for policymakers to deliver some modest interest rate cuts in the 6 months ahead, but certainly nothing that should surprise markets. And all this has been driven by services strength. Recall that the effects from COVID were largely goods and energy price shocks. Well, now we're seeing sticky services demand, mainly in the US. And that's really a sign of aggregate employment fueling aggregate demand. But we're likely to see a much lower impulse for inflation here in both the UK and in Europe. And in fact, inflation is likely to reach 2% and maybe even dip below this quarter. All this is feeding into a very constructive earnings story for global corporates. We are seeing earnings revisions that are positive in Japan, UK and Europe, and they are now no longer negative in the UK, and in fact are beginning to trend towards positive. And this means the UK in particular, corporate UK, can catch up to Europe. Over the next 2 years, markets expect US earnings to be around about 25% and European earnings to be around about 15%. In the UK, it's only around 10%, so there's plenty of room for the UK to catch up to Europe in particular. And this should lead to further upward pressure on UK equity prices. So it's very much a broadening global equity story driven by not just the US, but by Europe, the UK and parts of emerging markets. And this is a very constructive story given we're past peak interest rates and we'll hopefully see some interest rate cuts ahead. So that's all for today, but please do join us tomorrow for the Week in Markets review. Thank you.